It's December 2025. While most Americans are caught up in the holiday rush, two historic financial events are quietly unfolding. First, gold has skyrocketed to a new all-time high of nearly $4,400 an ounce, more than doubling its price in less than 3 years. Second, inside a secure facility somewhere in the BRICS economic bloc, the first real transactions are being processed using a brand new digital trade instrument called the unit. Now, this isn't a cryptocurrency like Bitcoin, and it's not a payment system like PayPal. The unit is a gold-anchored settlement mechanism specifically designed to bypass the US dollar. Imagine a new kind of money for international trade, backed 40% by physical gold and 60% by a basket of BRICS currencies: the Chinese yuan, Russian ruble, Indian rupee, and others. Right now, it's being tested for cross-border settlements between Brazil, Russia, India, China, and South Africa. The transaction volumes are still small, but the implications are massive. For the first time in modern history, a functional alternative to the dollar for global trade actually exists and is already operational. Think about this. The BRICS nations now represent about 45% of the world's population, 36% of global GDP, and control over 40% of the world's oil production. These countries are building a parallel financial universe deliberately designed to reduce their reliance on the US dollar. Every single month, more trade is settled outside the dollar system, more central banks are buying gold at record rates, and more global reserves are shifting away from US government bonds. This isn't a future prediction, it's happening right now. For over 80 years, ever since the Bretton Woods Conference in 1944, the US dollar has been the world's primary reserve currency. This status gave the United States what's often called an exorbitant privilege. It allowed us to run massive trade deficits, borrow trillions of dollars at super low interest rates, and essentially export our inflation to the rest of the world. Because everyone needed dollars to trade, the US could print money without facing the immediate, painful consequences that other countries would. But that system is now visibly eroding. History teaches us that reserve currencies don't last forever. The shift from the British pound to the US dollar, for example, took about 30 years. It was driven by war, crippling debt, and a major shift in economic power. After World War I, Britain was economically weakened and drowning in debt. The United States, on the other hand, emerged as the world's biggest creditor and held the most gold. The pound's dominance slowly faded until the Bretton Woods Agreement made the dollar's supremacy official. Today, we're seeing a similar pattern repeat itself. The United States is militarily overextended, with hundreds of bases around the globe, and is staggering under a national debt of over $36 trillion that's more than 125% of our entire economic output for a year. Meanwhile, China has become the world's manufacturing powerhouse, its biggest exporter, and the top trading partner for over 120 countries. In terms of purchasing power, China's economy actually surpassed the US economy years ago. And at the same time, China and its BRICS allies are hoarding gold at a pace never seen before. But what makes this transition different, and much faster, is that it's being deliberately engineered. The BRICS nations all share a powerful motivation: to escape a dollar-based system that can be used as a weapon through sanctions and asset freezes. When the US froze hundreds of billions of dollars in Russian central bank reserves back in 2022, it sent a shockwave through the financial world. The message was loud and clear: holding dollar reserves is not politically neutral. Your money is safe if your policies don't align with Washington's. Gold, on the other hand, is a physical asset. It's anonymous and can't be frozen or digitally seized by a foreign government. So, how exactly is this de-dollarization happening? There are three main engines driving this shift. The first is the BRICS unit itself. It acts as a settlement tool, a bridge between currencies. Instead of a Brazilian company having to convert its currency into dollars to buy goods from China. It can now convert its money into the unit, complete the transaction, and then the Chinese company converts the unit back into its own currency. The US dollar is completely cut out of the loop. Right now, the volume is modest, maybe around $15 billion, but the infrastructure is built, and it's growing. The second engine is the explosion of bilateral trade deals using local currencies. China and Russia now conduct nearly 95% of their trade directly in yuan and rubles. China and Brazil are doing the same with the yuan and the riel. India and Russia are increasingly settling trade in rupees. And in a truly groundbreaking move, Saudi Arabia, the heart of the petrodollar system for 50 years, has started accepting Chinese yuan for its oil. Taken together, over $400 billion in annual trade has already shifted away from the dollar in just the last couple of years. The third and perhaps most telling engine is the unprecedented gold buying spree by central banks. For 3 years straight, central banks around the world have bought over 1,000 tons of gold annually. This is the highest sustained level of buying since the original Bretton Woods system collapsed in the early 1970s. Countries like China, Russia, India, and Turkey are leading the charge. Officially, the BRICS nations hold over 6,000 tons of gold, but many experts believe they're true. Undisclosed holdings are closer to 8,000 tons. While they're buying gold, they're selling U.S. debt. Foreign holdings of U.S. Treasury bonds are steadily declining. China has slashed its holdings by over $500 billion from its peak. Saudi Arabia and Japan have also been reducing their exposure. As foreign appetite for our debt weakens, who's left to buy it? Increasingly, it's our own Federal Reserve, which means we are essentially printing money to pay our bills. This structural change is undeniable. The dollar's share of global reserves has fallen from over 71% in the year 2000 to just about 58% by the end of 2025. And that decline is getting faster. If these trends continue, the dollar could lose its status as the majority reserve currency within the next decade. What comes next? Most likely, a multipolar currency world, where the dollar, the euro, the yuan, and maybe a BRICS-backed instrument all coexist. Even in that scenario, the U.S. loses its exorbitant privilege. Our trade deficits would have to shrink, borrowing would become much more expensive, the cost of imported goods would soar, and our standard of living would decline. On the flip side, countries with trade surpluses, commodity exporters, and nations holding large gold reserves stand to benefit enormously. Gold has already more than doubled in price since 2023, and it remains the asset of choice for central banks preparing for this new monetary order. As gold becomes a formal part of new settlement systems like the unit, its role as a neutral, reliable store of value only gets stronger. This isn't a conspiracy theory or a distant what-if scenario. It's a historic process that is already well underway. The financial plumbing has been built, the economic incentives are aligned, and the political will among a huge portion of the world is crystal clear. In December 2025, we are witnessing the opening act of the most significant monetary shift since World War II, and gold's record-breaking price in a random spike. It's a flashing sign, showing us exactly where global trust and confidence are moving. Understanding this shift isn't about trying to get rich quick. It's about recognizing a fundamental realignment of global power that has happened many times before. Those who see it early will have the chance to protect themselves and their wealth through what will be one of the greatest financial transitions of our lifetime. Thanks for watching. If you found this information valuable, please consider liking this video and subscribing to the channel for more updates on this critical story. See you next time.